I'm John Hanna for CDTV.net in New York, and we have Greg Womack, President of Womack Investment Advisors, joining us from Edmond, Oklahoma. Good morning, Greg.
Good morning, John.
How are you today, sir?
Well, we're doing well. Just had a good weekend, but a busy Friday but with the markets, and we're busy again today. With all the uncertainty going on in Washington, so we're got our plates full right now.
Right. When you said busy last weekend today, you told me in the past that you're actively managing your clients' money, right?
Right. Yeah, we manage some individual accounts. We also have two funds that we limited partnership funds that we run, and so we're just last week or so, and coming, of course now just with the Monday before the August 2nd deadline, there's still no official deal in place. We're just kind of hedging some bets and making sure if the floodgates open on the downside that we have some protection in place.
Right. And what do you think is gonna potential that might potentially happen when you said like when the downside happens, and then we're gonna also the next question would be what would be the upside, with regards to that deal.
Well, as far as what could trigger a down or an uptick.
Right.
Yeah. Well, of course, them not coming to an agreement would be, I think, pretty much devastating. Even though it's the August 2nd deadline, it's kind of an arbitrary number. I think psychologically the markets would not take that, very well. So if there's no positive vote by tomorrow morning, prepare for more volatility. If they go ahead and vote this debt ceiling deal in, there's a good chance we might get a little bump. But I thought we would have had that this morning when the pre-market, the futures were up. Even last night when the Asian markets opened, the Dow was up 170 plus in the futures. We opened up. I know at one time we traded probably close to 150, and then it reversed. And now we're down about 120 as we speak, as about noon Eastern time at New York on August the 1st. So we might get a bump. I think the market is telling us something, that this deal is kind of it's okay, it's temporary, and there's a lot of issues that aren't resolved when it comes to cutting and what's going to be cut, and it doesn't really take a big chunk out of the deficit at all. So, but it's something. There's no tax increases. The Tea Party would get what they want. The president would get what he would want, meaning push this out past the elections. But there are still decisions that would have to be made by committee within 6 months, from what I understand. And so it's kind of a temporary relief, and so the markets are reacting to that, which is not a big improvement. We're getting the deal possibly, but then the economic data is probably what's hurting. Last week we had the estimates from the Bureau of Economic Analysis. The first estimate was 1.3% GDP growth, and then something was more discouraging. They had the downward revision to the estimate for the first quarter, and only up 0.4%, so barely positive on the first quarter, and substantially lower than the earlier 1.9% figure they reported for the first quarter. So what growth there was in the second quarter was fueled by exports, private equity investments, or inventory investment, and federal spending. And so, and just this morning, there was it come out that the ISM, the Institute for Supply Management, has dropped also. And so, new orders, we had the Department of Commerce on durable good orders fell 2.1% in June. This was the second decline in the last 3 months. So it seems like the recovery is kind of losing a little bit of steam. How long will this be a trend? What's going to turn that around in the third quarter? It's going to be, it's hard to see at this point, but definitely there is some softening in the economy going on. So the markets are, don't right now have a lot of rejoice over, and so it's probably best to protect and be a little bit cautious going into this week.
When you say you earlier you wanted to do some protections, how does one go about protecting their investments?
Well, there's several ways, John. If you're owning stocks long, you want to go in and look at a chart and try to say, okay, well, if this stock fell below its previous low of the last few months or 6 months or whatever, you want to probably put in a sell stop as one way you can do that. So you also look at like the 50-day moving average, the 200-day. So if you have a substantial gains in your stocks, you want to try to protect those gains. But then if you don't have a lot of gains, you want to protect your principal. So looking at a sell stop, which is a good to cancel order that says I want to sell XYZ Corp at $50 a share and may be trading at 55 right now. And what that says, if that stock hits that $50 price, then it will become a market order. And so sell stops or sell stop orders are one way to do that. It's a sell stop limit to where it would not become an order until it hits that price. Another way to do that, protect your downside, would be buy a put option. If you have experience with options, and that's one of the things that we are doing, where we go in and buy a put option on a stock, say somewhere below where it's trading now, in case things fully fell apart, say over the next 6 months, you're protected at that level. Now that does cost you a premium because you're basically buying the option to put that stock to somebody at that strike price. So if your stock's trading for 55 and you say, hey, if this thing falls apart and I want it out at 50, then you buy a put option. And if that thing does fall below 50, you're in the money, and it actually gains in value. So if you paid $1,000 for that option, then it could actually start making you money. As your stock price goes down, that option price goes up and mitigates you or protects you at that $50 level. So it's though the stock were never trading below 50 once you have that option in there. But options can be very complex, so you want to make sure you go out far enough in expiration. Usually they're 1 month, at a time, and you can go out as far as 2 years if you wanted to. But you probably want to give it, at least 3 to 6 months to go out when you're buying these options. So, because if you don't, if your option you bought at 50 does not hit that 50 and you're not in the money on that option, then it starts to deteriorate and you have to get out of that option, or you'll give up all the premiums that you paid for it. So a lot of complexities there, but that is something that we do, and it helps protect us at a certain level on the market or on individual securities.
There you go. That's Greg Womack, President of Womack Investment Advisors, joining us from Edmond, Oklahoma, and I'm John Hanna for CDTV.net in New York.